You considered your crypto secure. From remote cybercriminals, it often is. However, vulnerabilities can arise from legal systems. Stay with me because I'm about to explain the hybrid trust structure commonly used by the affluent to strengthen the resilience of their crypto holding. Let's get into it. You're carefully protecting your seed phrases, but what if I told you that legal actions such as subpoenas can pose significant risks beyond digital threats? While much of the crypto community emphasizes digital security, high net worth individuals often employ legal structures to enhance their protection of their assets. They recognize that technological control and legal ownership are distinct concepts. A court focuses on enforceable obligations rather than the specifics of your wallet setup. I'll also highlight a key legal vulnerability that could expose your portfolio to lawsuits, creditors, or government action. This goes beyond password hygiene. It's about leveraging legal frameworks to safeguard assets. This brings us to something called the illusion of digital security and real-world threat. You've implemented strong measures, a hardware wallet like a ledger or Trezor stored securely, seed phrases divided and dispersed, multi-signature setups for substantial holdings. You've avoided unreliable platforms and phishing attempts. You considered your crypto secure. From remote cybercriminals, it often is. However, vulnerabilities can arise from legal systems. While blockchain decentralization provides independence from traditional finance, it doesn't inherently shield against court directives. Private keys, being portable, can be subject to judicial orders compelling disclosure under penalty of contempt, including fines or incarceration. This highlights a key distinction. A court order can override digital safeguards. To illustrate, consider these realistic scenarios. A car accident leading to litigation. Opposing counsel may discover your assets through legal processes, identifying exchanges, links, or transaction records. If held personally, your crypto could be targeted to satisfy judgments, similar to bank accounts. Second, a failed business venture such as a DAO or startup. If investors pursue personal claims, personally held crypto may become liable for repayments. Third, divorce proceedings. Courts increasingly address digital assets with specialists tracing blockchain activity. If deemed marital property, you could be required to divide it. Non-compliance risks contempt charges. Finally, debts to creditors or agencies like the IRS. Cryptocurrency is classified as property by the IRS, making it accessible for taxes and potentially seizable for obligation. U.S. authorities have indeed seized substantial crypto amounts, with enforcement efforts growing under evolving regulations. In these cases, hardware and seed phrases don't prevent compelled access. Personal ownership exposes assets to legal reach, underscoring that true protection involves both technical and legal strategies. And this brings us to the two flawed pillars, why your LLC or basic trust isn't enough. Recognizing personal holding risks, you might explore options like an LLC or a trust. Common suggestions for asset protection. These provide some benefits but have limitations for dedicated crypto investors, potentially faltering under rigorous legal scrutiny. Consider Pillar 1, the standalone LLC. Often recommended, such as a Wyoming LLC, it positions the entity as the asset owner, creating separation. A key feature in states like Wyoming is a charging order protection, limiting creditors to distributions rather than direct seizures for personal judgments. By avoiding payouts, you theoretically restrict their gains. However, challenges do exist. Courts in your residence, such as California or New York, may not fully defer to another state's rules, potentially ordering distributions, receivership, or key disclosure. Refusal invites contempt. Additionally, piercing the corporate veil is a risk if the LLC isn't maintained separately via commingled funds or poor records. Courts could then treat it as an extension of you, nullifying protections. Privacy is also limited. While ownership details may not be public, subpoenas to related parties can reveal them. An LLC offers value for moderate needs but isn't comprehensive. Now, Pillar 2, the standalone irrevocable trust. This transfers assets to a trustee, removing your ownership and shielding from personal creditors. It's effective for estate planning and avoiding probate. For active crypto management, it restricts flexibility. Transactions require trustee approval, slowing responses in volatile markets. Selecting a trustee knowledgeable in crypto, handing off keys, contracts, or protocols is difficult. Traditional professionals may lack expertise, risking errors or overly cautious approaches. protection comes at the cost of operational agility. Thus, the LLC prioritizes control with weaker barriers, while the trust emphasizes shields but reduces autonomy. Affluent individuals address this by integrating both. If this seems intricate, it is, surpassing basic online tips. Effective implementation hinges on nuances. Errors can undermine the setup. Book a call at numeratus.us for us to evaluate your circumstances and risk. Link in the description. Avoid assumptions. Explore tailored options. So now let's talk about the blueprint of the crypto fortress. To balance LLC control with trust protection, the wealthy integrate them together. An irrevocable or living revocable asset protection trust owns a single member LLC. Here's why it works. The LLC serves as the operational hub, holding wallets and accounts. As its manager, you retain daily authority to trade, stake, or adjust holdings efficiently. Ownership resides within the trust, severing your personal link to those assets. In a lawsuit scenario, asset searches reveal no direct ownership. Creditors can't easily target the LLC or trust for personal debts, creating a robust separation. Analogously, the LLC is the command center, the trust forms the defense perimeter. Draft the structure, customize documents for digital assets, including flight provisions. Fund the structure, transfer assets pre and post threat. Appoint fiduciaries, choose crypto-savvy trustees and protectors. Maintain compliance, ensure separate records and filings. Have an ongoing review, annual updates for changes. This hybrid offers operational flexibility and strong defenses, addressing liability, privacy, and inheritance. And here are the devastating risks of getting it absolutely wrong. Such structures require careful execution. Flaws can exacerbate vulnerabilities, fostering overconfidence while leaving gaps. A primary error is post-threat transfers, deemed fraudulent and reversible by courts. Setup must precede issues. Neglecting formalities like fund mixing invites veil piercing, collapsing protections. Inadequate drafting, such as missed filings or flawed clauses, can fail under challenge or create tax issues. Non-specialists heighten risks. Misstructuring may also inadvertently limit access, hindering market participation. Professional expertise is crucial. Failures can lead to asset loss beyond setup costs. A crypto mantra, not your keys, not your coins, addresses digital risks. But legal threats, divorces, accidents, disputes, seizures demand complementary strategies. Digital tools guard against hacks. Legal ones mitigate compelled disclosures. This hybrid fortress, a trust-owned manager-controlled LLC, provides a balanced approach. Control for management and barriers against claims. It integrates protection, privacy, and planning. This shifts from uncertainty to structured security, elevating from speculation to preservation. Act proactively. For serious protection, schedule a confidential analysis via the description link below and book a call with Numeratus.us. Build resilience now.